Nathan's Famous, the food and restaurant company, is growing rapidly, but is this stock a buy right now? Welcome to the Food Fund. We're diving deep into Nathan's after the earnings report. Can Nathan's share price rocket even higher? If you own Nathan's, or you're thinking about it, you need to see this. Special thanks to Invictus Compounding for suggesting this analysis over on Threads. Let's start with Nathan's stock performance. Over the last year, you're looking at an amazing 42% CAGR. Zoom out to 5 years and it's still great, a 15% CAGR. This company has been gaining nicely for a long time. When we look at the fundamentals, we see why the share price has been doing so well. Gross margin is 34%. This is in line with many of its peers. Revenue has grown at 17% over the past 5 years, now at $150.4 million. Growth has slowed but is still moving in the right direction. The cash flow looks interesting. Operating cash flow increasing at a 13% CAGR. CapEx improved at a 13% CAGR. The result? Free cash flow has improved at a 14% CAGR. This is great, but the trailing 12 months free cash flow has fallen back to 2024 levels over the past quarter. Is this a sign of trouble ahead? Weighted average shares outstanding have decreased just slightly over time, going from 4.12 million shares in 2021 to 4.11 million shares most recently. Nathan's was reducing share count until 2024, but has been diluting shareholders very slowly since then. Next, return on invested capital. This tells us how efficiently management is investing in the company. Going from 110% in 2021 to 127% most recently, management has gotten more efficient over time. The company is profitable and has likely been living off of its strong initial investment. For operational efficiency, measured by the cash conversion cycle, Nathan's is actually doing poorly. It went from 18 days to 29 days, showing a huge drop in efficiency. Finally, debt. Net debt to EBITDA has fallen from 2.7 in 2021 to 0.6 most recently. This debt profile looks great. Management has been consistently paying down debt while growing earnings. Now, let's compare Nathan's performance against the gold standard, the S&P 500. Investing $10,000 in Nathan's would have grown the investment to $23,165, compared to $36,399 in the S&P 500. That's an annualized return of 9.2% for Nathan's versus 14.4% for the S&P 500. Nathan's also showed higher volatility and a larger maximum drawdown. Unsurprisingly, risk-adjusted returns, Sharpe and Sortino ratios, were worse for Nathan's. The restaurant may show promise, but investors would have been better off owning the S&P 500 instead. Nathan's Famous was founded in 1916 when Nathan Handwerker, using a secret recipe from his wife, Ida, and a $300 loan, opened a hot dog stand on Coney Island, New York. Beyond its classic hot dogs, Nathan's has expanded its offerings to include crinkle-cut fries, onion rings, and a variety of other branded products found in supermarkets across the country. Today, the company is headquartered in Jericho, New York, with approximately 258 employees. Nathan shows promise and frankly reminds me a lot of Portillo's. Based on my proprietary scoring system, I give Nathan's a 5 out of 10. Let's dive deeper into why. Before I share my final thoughts on that, if this analysis was helpful, please hit that like button to let YouTube know. It really helps the channel. And if you want more deep dives into food, beverage, and restaurant stocks, subscribe and ring the notification bell so you don't miss the next video. Your support means the world to the Food Fund. Also, don't forget to turn on your notifications if you are watching on a mobile device. So my final thoughts on Nathan's. Let's write it out in the spreadsheet. It is a food company with a gross margin of 34%. The 5-year revenue per share CAGR is 8%, and the 5-year free cash flow per share CAGR is 15%. Solid margin and good growth here for this company. A return on invested capital of 127% is outstanding. Next, the cash conversion cycle of 29 days is high and is the largest warning sign for the company. A net debt to EBITDA of 0.6 means that the company could pay off its debt in a little over 6 months of earnings. Now let's switch our attention over to valuation. The price to earnings growth, or PEG ratio, is 1.8, indicating that Nathan's is slightly overvalued compared to its projected earnings growth. Nathan's has been consistently growing their revenue and free cash flow, which is a great sign. This means they're bringing in more money and have more leftover cash to reinvest in the business, pay down debt, and even reward shareholders with dividends, which they have a solid track record of doing. A lot of this growth is driven by their licensing business, where they partner with companies to sell their branded products in grocery stores. In fact, the restaurant portion of the business generates just over 10% of the revenue. The largest issue for me is the declining profit margins. While revenue is going up, the cost of goods, like beef and other ingredients, is rising even faster. Another thing to watch is their high cash conversion cycle. This value is high and rising, the opposite of what we want to see. Furthermore, I view cash conversion cycle as a leading indicator, and return on invested capital as a lagging indicator, meaning that I will expect a drop in return on invested capital if cash conversion cycle continues to rise. So what's the final verdict? Nathan's Famous has some clear strengths, especially its growing top-line revenue, free cash flow, and solid balance sheet. But the next few quarters are forecasting less tailwinds. For now, I am eager to follow this company and see how next quarter's results pan out. What do you think about Nathan's? Are you an investor? Share your thoughts in the comments below. I always love hearing from you. Check out some more videos right now, and remember to put your money where your mouth is.